I mean, we just saw this report. I'm sure you did. Goldman Sachs put out, thought China publicly stated they bought 5 metric tons of gold in October, but Goldman Sachs think they bought 55. So that's the case. That bid continues. That obviously is going to continue to prop up price through these banker slams that we're currently dealing with. The currency gets debased to the point where it becomes essentially worthless. You need a new structure. You need a new currency to get trade started again, to have some confidence in using it, and that the thing will retain its value. It's partially backed or fully redeemable into gold. That's just how it's always been. It's how this current system started.
In today's news recap, China secretly buys a large amount of gold. Goldman Sachs, 10 times more than official reports. A month ago, Goldman Sachs precious metals analyst Lina Thomas believed that due to the continuous purchasing of gold by central banks, especially the fervent pursuit of gold by China, gold would rise to $3,000 by the end of 2025. This view from the bank was quickly challenged by skeptics who argued that with the dollar reaching historic highs, gold is unlikely to maintain its upward momentum, and a stronger dollar is one of the biggest consensus points of the Trump trade. First, Goldman economists expect that in a global monetary easing cycle, the Federal Reserve will lower interest rates while the dollar strengthens, but it will be U.S. policy rates that drive investor demand for gold, with the dollar not playing a significant additional role. In the bank's baseline assumption, a 100 basis point cut by the Federal Reserve would boost gold prices by 7% by the end of 2025. But if the Fed only cuts rates once more, gold prices are estimated to rise to $2,890 per ounce. Secondly, Thomas disagrees with the view that a stronger dollar will prevent central banks from structurally increasing their gold purchases, as central banks tend to purchase gold internationally with dollar reserves. In fact, large central bank buyers tend to increase their demand for gold when their local currencies are weak, to bolster confidence in their domestic currencies. Third, the trend of both the dollar and gold prices rising with uncertainty supports their role as a hedge in a portfolio, including hedging against tariff escalations. Finally, Goldman economists expect that broader easing policies should have a roughly neutral net impact on China's gold retail demand, as the stimulus from lower interest rates on gold demand is roughly offset by the impact of rising local gold prices. Before we dive into the best clips of the week, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
It will happen. What frustrates me is, one, lack of patience, right? Everybody wants something right now. It didn't happen this week, then, or if I don't make 20% in a day, nobody has any patience. So that's always very frustrating. But what will happen is not this binary flip. People think, well, there's going to be a BRICS currency, there's going to be an alternative to the dollar and all this stuff. And that there's somehow this binary choice where one day it's a dollar and then, then all of a sudden the dollar just goes away. And then we have this. It's not going to work that way. I mentioned earlier, you back your currency, whatever the new one is, with gold or with a basket of gold with other things, anything to give it some heft, right? Some gravitas, like they used to say about George Bush. Remember that back in the day? You have to, if you're going to, let's say sometime in the next however many years, an alternative is put out there and to rival the dollar, or at least to allow these countries that see their foreign policy as potentially adversarial to the U.S. and the West, and so they don't want to get cut off the U.S. system like what we did to Russia, and say, well, we better come up with our own system here. Well, to encourage use of that system, you can't just say, so we're going to use the yuan. And, well, no, let's sit back and go, I don't know about that. But if you come up with something that's like a basket of everybody else's currency and half gold, or I'm just positing whatever, but you anchor it with something so that you have confidence that the thing will retain some value, so that if you trade from one country to another and you use this as the conduit, you end up with a reserve of these things. You don't want them just, getting cut in half in their value in 6 months, like an emerging market currency. So you anchor it with gold, and that gives it some, like I said, some heft to allow, okay, you know what, we will use that a little bit. And then that becomes kind of a death by, well, we're already in a death by 1,000 cuts. That just increases the pace of cuts into the US dollar's credibility. And what that ultimately does is just simply supply and demand, because we're in this period where the supply of dollars is growing almost exponentially at this point. Now, I'm not talking about M2 and all that kind of stuff. I'm just talking about the U.S. debt and the amount of dollars, because every dollar is debt, and the debt is increasing so quickly now, and the amount of dollars needed to service that debt is going up. They're just going up like this together. So we have the supply of dollars that's increasing, and if you can begin to cut into the demand side of that by these alternative currencies, then again, that's Econ 101. Increasing supply with falling demand makes a lower value, a lower price. And that's, again, ultimately, that's where all this is headed, Andy. It's, again, people get so frustrated. I want this to happen now. There's a BRICS meeting back in October. Oh, but there's not ever going to be a big, I'm going to reach over and turn off a light. It doesn't work that way, but it's going to be this gradual, continual move away from the dollar and the dollar share. Again, that's less demand for dollars. At the same time, supply is increasing.
In today's episode news recap, silver almost keeps pace with gold in 2024. Silver surged 24.4% in 2024, driven by industrial demand, supply deficits, and investment potential via ETFs like ISLN. So congrats to the savvy stackers on their silver holdings. As 2024 draws to a close, silver has emerged as a standout performer in the precious metals market. Although gold has performed slightly better so far, plus 27.8% year to date. Silver benefits from its dual role as both an industrial and investment asset. On the other side, silver has jumped 24.4% so far in 2024, nearly matching gold's performance as of December 27th, after rebounding from a 3-month low of $29 per ounce on December 19th. Silver ended the week at $29.61. This rebound was driven by macroeconomic factors, rising industrial demand, and indirect support from aggressive central bank gold purchases. These drivers could support silver's continued upward momentum in 2025. Unlike gold, approximately 55% of silver's demand comes from industrial applications. In 2024, this demand surged, fueled by the growth in the electronics and renewable energy sectors, particularly photovoltaic, solar technologies. Solar energy alone now accounts for nearly 20% of industrial silver consumption, highlighting the global shift towards sustainable infrastructure. This heightened demand has led to physical tightness in the silver market, resulting in a supply deficit for the 4th consecutive year, according to the Silver Institute. Miners continue to face significant challenges in discovering new silver deposits, further exacerbating the structural supply deficit. This combination of robust industrial demand and constrained supply positions silver as a compelling candidate to outperform gold in the years ahead, especially as global interest in renewable energy continues to grow.
There's a job called the bullion banks, the bullion bankers that operate in London and New York. There's a management of price. There's the physical price where metal actually flows, and there's this paper price that actually wags that spot tail, if you will. That paper price, though, can only move so far because you actually have to be able to deliver physical metal at that price. So, which is kind of supportive of price. Now, I know we've been getting the crud kicked out of us for the last week. But when people say, well, gold's going back under 2,000, well, actually, I guess if all central bank demand and everything else dries up, okay, then maybe they can bring it down that far. But the problem for these bankers is they've got to flow physical metal into this price that's derived by the trading of futures contracts, which puts them in a bind from time to time. We saw this just last week, Andy. It's crazy. Very unusual occurrences were going on, primarily rooted on the COMEX in New York, where the current, or what had been what we call the front month, the December contracts, are off the board and allegedly making what we can delivery. And the price of those front month contracts started to blow out higher versus the spot price. Well, there's no way that should happen, for a number of reasons. But it did for both gold and silver. And it was evidence of some kind of supply issue. Well, lo and behold, a week later, that supply issue seems to be fixed. As silver's down 12% in 5 days. What can ultimately break that stranglehold that these banks have, really, honestly, is just physical supply and demand. Get to the point where this system, this trading system, this derivative-based pricing scheme can no longer flow metal at any price because there's just not enough metal to be found. Obviously, that's not the case yet. But that's why it's so important. We've been stressing this for 15 years. If you want to find free and fair price, something that's actually where price is derived through the trading of physical or something close to it rather than these phony baloney futures contracts, then all we can do is continue to take metal off of the system, offload it.
What do you think of Craig's take on the future of gold and silver? Are his predictions aligned with your outlook? Post your thoughts in the comments below. Let's spark a great conversation about where these markets are heading. Thanks for watching, and check this video right here because it's a perfect fit for you. I'll see you on the other side.